Good morning, ladies and gentlemen. It's my pleasure and privilege to be here this morning and to have been asked to chair and moderate this august panel of banking and ancillary services experts. My name is Rizwan Desai, and I'm a senior partner of Collins Newman & Company, the Botswana member law firm of ALN. I'm also currently the non-executive chairman of Barclays Bank of Botswana, which, as many of you will know, in turn is a subsidiary of Barclays Africa Group, operating in 10 African jurisdictions. Now, ladies and gentlemen, our task as a panel this morning is to touch upon a subject literally as vast as the African continent itself. Essentially, the challenges of and opportunities presented by banking and finance in Africa. You've already heard the fantastic panel that preceded this one from them, and will continue to hear throughout today's proceedings and tomorrow of the rich and diverse opportunities presented in this, the second decade of this 21st century insofar as Africa is concerned. Now, there are many, it is of course clear and true. However, the flip side, unfortunately, can never be far away and must be tackled on, as we say in Africa, like a bull by its horns. So what do I mean by opportunities and challenges in the banking and financial context? Well, Africa, we've all heard, may very well be the final frontier, not space, Africa. Even more so, perhaps especially more so in the banking world. In a recent report, the Economist Intelligence Unit painted a picture of two scenarios. In the more conservative scenario, driven just by economic expansion, it estimated that looking at the industry in 16 African countries, that industry would boost its assets by 178% to US $980 billion by 2020. That's the more conservative estimate. In the more likely scenario, driven by economic growth and financial deepening, assets are foreseen to expand by 248% to US $1.37 trillion by the end of the decade. So that, ladies and gentlemen, is clearly hugely significant. Looked at another way, and again as reported in an article in The Economist magazine in 2013, headed Banking in Africa, Continent of Dreams. Only 25% of adults looked at across sub-Saharan Africa as a whole have access to formal financial institutions, and only 3% have access to credit cards. I'm sure you'll agree with me that these are quite staggering statistics representing a vast and literally untapped market. So of course, where there are opportunities, there are also always challenges, and at a macro level, as posited by the EIB in one of its reports, poverty is pervasive, human development is low, and growth has not been inclusive. And additionally, of course, and you've heard about this before, and we'll hear about it again later on today and tomorrow, there's an infrastructure gap, and the investment climate and regulatory environment can be relatively poor depending on the relevant jurisdiction you find yourself in. There are still weaknesses in governance and institutional capacity that need to be addressed. And within the broader banking and financial services sector, there are also challenges to the traditional bricks and mortar banking model from new entrants who are technology savvy and have taken effectively the lead in mobile banking. Of course, a challenge to one industry player is an opportunity for another. And the fact that the banking environment in Africa is undergoing vast structural change with a number of trends coming to the fore is simply a fact. So we will this morning, ladies and gentlemen, be covering some of these trends, being broadly and in sequence the particular challenges of running and growing a bank in Africa, the peculiarities of that. We'll hear a little about that from our experts. Financial inclusion of the unbanked and the role of technology and innovative banking products in reaching the masses. We'll touch on that. And last but not least, the role of a strong and effective central bank to provide the governance and regulatory framework for all of these fantastic operations to take place. So helping me and you unpack these trends, ladies and gentlemen, and to see effectively how Africa can harvest the horizon, so to speak, is our panel of experts, whom I will show you will agree with me after I tell you a little more about them, that we could not have chosen this morning more wisely or indeed more widely. So if I can just introduce you to our esteemed panelists, starting off, and I think I have to John Vitalo, the CEO of Atlas Mara. John has extensive African and international banking experience at leading global financial institutions. He has over 20 years of international banking experience, including M&A, structured finance and markets, extensive emerging markets, banking experience, and deep risk management knowledge and experience. Past roles include the CEO of Barclays Middle East and North Africa CEO, Absa Capital Barclays Africa CEO of Global Markets and COO of Emerging Markets for Barclays Capital, the Director of E-Commerce for Emerging Markets, Proprietary Trader for the Emerging Markets Group, Global Head of the Emerging Markets Structured Financing and Repo Business, and Head of the Emerging Markets Fixed Income Arbitrage Desk at Credit Suisse, First Boston. John, there's a lot of emerging markets there, so I think look forward to hearing from you. Next, Mr. Mohamed Niaga, Chairman of the Central Bank of Kenya. Mohamed holds an LLB and LLM degrees from the University of Nairobi. He's a managing partner of Mohamed Nyugai Advocates in Nairobi. He also holds a diploma in law from the Kenya School of Law. In addition to being a lawyer, he's a certified public secretary, a certified company director, and a member of the London Institute of Directors, immediate past chairman of Ecobank. He was called to the bar in 1985 and specializes in corporate finance, civil and commercial litigation, and is a recognized authority on bank securities. In addition to the practice of law, Mohamed is the immediate past vice chairman of the Law Reform Commission and chairman of the Business Laws Committee, and is in addition presently a certified training consultant in corporate governance with the Commonwealth Association for Corporate Governance. Next, I have the pleasure of introducing in sequence Mr. Sherazad Mazari, the managing partner of Sabre Capital, who has over 35 years of direct management in the banking sector. Sabre advises an investment and management company focusing on emerging markets and particularly in the banking sector. He has tons of experience in M&A and transformation roles in wholesale, SME, and retail banking. He's the CEO of Africa for Standard Chartered Bank, Global Head of Lending, Standard Chartered Bank, and other senior positions in Citibank and Standard Chartered across 30 countries in emerging markets. Next to him is Mr. Sami Ghana, a founding partner of One Rena, which is an investment holding company with a diversified portfolio in East African banking and insurance sectors, as well, of course, as a corporate associate director at Genghis Capital, where he heads the equity and debt capital market advisory activities. Sam has been involved in the East African investment banking industry since 2009, when he joined Proparco Regional Office in Nairobi in charge of sourcing and structuring private equity and debt investments across various industries. Mr. Ghanam holds a Master in Science and Management from EM Lyon, a leading European business school. And then last but not least, Mr. Tarun Mohan, who is the CEO of NextGen Telesolutions Private Limited. Tarun has over 3 decades of experience in managing technology companies and as an entrepreneur. This has seen him come up with many firsts, including setting up India's first and largest precision sheet metal fabrication facility. He holds patents in mobile radio services, mobile device integrated on divorce portals, and DRM rep content distribution platforms on micro SD cards. No doubt he'll explain to us all of that. He is a silver medal graduate of BTech, Indian Institute of Technology. Now, ladies and gentlemen, without further ado, let's get to what you've been waiting for, which is the questions and the responses. So I think, John, let's start with you. Throwing out a couple of questions for you to chew on. As the head of a Pan-African group, could you tell us what qualities, in your view, an African bank needs or has to have that big international banks lack? And then just as a follow-up to that, you've obviously come in as the Atlas Mara Group to invest in a group of African banks. What is more compelling in your view, the model of investing in banks by private equity, which we'll hear more about in the next session, or buying and operating banks and the challenges that come with that? So over to you, John.
Thank you. It's working. Thank you, Rizwan, and good morning, everybody. So, question around, I'm going to take the, is it all right if I take the second question first? And that is around the private equity model versus the Atlas, versus building a banking group. Now, of course, you'd expect me to have a bias to that question, but I hope I can convince some of you around my answer as well. Africa is a place where you have to get very involved on the ground. I don't think I need to tell you all of that, as many of you as Africans and then even more doing business and living on the continent. It takes really getting involved as operators rather than as a financial investor. I think that's one of the most important things. Another very important thing is the permanence of capital. One of the things that we see is that national regulators, finance ministries, heads of state, and so forth prefer capital going into their banking system, particularly when you're making acquisitions of banks or buying large stakes of banks in banks, for that capital to have a high degree of permanence attached to it. And of course, private equity, the typical private equity model does not have permanence attached to the capital. So the capital goes in, the business grows, 3, 4, 5 years later, the money needs to be returned to the limited partners, and so either that large stake in a bank or the bank itself has to be sold again in 3 or 4 or 5 years. And so we think that from many conversations we've had across regulators, heads of state, finance ministries, and so forth, the idea of if you have a choice between money that's going to come in and then have to be flipped to another owner in 3 or 4 or 5 years versus permanent capital of a banking group, that's also a critical point. I want to speak a little bit to the first question as well, and that is the qualities of an African bank versus the traditional international banks. And these two things, I think, touch each other. The two questions that Rizwan touched or asked, they touch each other. They kind of intertwine. I bring to the question a perspective of having worked in Africa and run businesses in Africa for one of those large international banks, and now running a company that is establishing an African footprint by buying local African banks. One of the things that is happening, and the reason why banking is such an attractive prospect in Africa right now is because of the juxtaposition between what's happening with flows of capital to the banking system relative to the opportunity set in Africa. You've heard, you know that you've heard this morning, and you already know a lot about what the opportunity set is in Africa. Things around urbanization, very low penetration of bank accounts, very young populations. You know, 15% of Spain is under the age of 40, and 15% of Spain is 15 or less, under the age of 15 or less. 40% of Tanzania is under the age of 15 or less. We could go on and on with these statistics, you know them, but the point is that these are all things that portend for very strong growth in the demand for financial services for decades. These are trends that are going to run for decades, and they will lead to they are leading to and will continue to lead to for decades strong demand for financial services. Juxtapose that against what are the traditional flows of capital doing to the banking system in Africa. Banking systems, each country, they have stalled and in some cases going into reverse. Why? Because the traditional sources of banking capital in many African countries, not all of them, but many of them, have come from, until recently, the large international banks like Rizwan referred to. British banks, French banks, Portuguese banks in the case of the Lusophone countries, and a couple of other bits and pieces, Belgium, for example, in 1 or 2 countries. Because of what's happened in Europe with Basel III and with bank regulation, and again from my experience inside a big international bank, they're under tremendous pressure regulatorily to pull back towards their home country, to pull back to the UK, to pull back to France, to pull back to Portugal, reduce risk, reduce the number of countries you're in, reduce the size of your balance sheet, and that force is unstoppable. They cannot resist that force. So you have, at the same time as where there's this tremendous growth and demand for financial services, the traditional sources of capital to supply towards it have stagnated at best. That creates opportunities for new entrants to supply that capital. So that supply of capital from new entrants that are not the large is a big difference. I want to speak one more difference, Rizwan, and then we're trying to be quick so we have time for dialogue. One more difference. The large international banks doing business in Africa have tended to focus on the top end of the client pyramid, whether it's corporations on one hand or individuals on the other. They have tended to want to bank because that's what sort of fits the if you like, the kind of European cookie cutter approach. The big end, the top end of the client pyramid, the large multinationals and the largest local corporate champions, and then the affluent, wealthy and affluent on the retail side. A truly African bank must serve underserved segments. I think that's a huge difference. Now, to do that, that goes back to my first point around requiring being on the ground with a deep, nuanced sense of each market to be able to do that safely. I'll hand back, Rizwan. Thank you.
Thank you very much, John. I think just leading off that, you made a couple of very, I think, important points with regard to how international investors are now looking to bring in these capital flows, potential opportunities posed by the regulatory restrictions that now exist, Basel II, Basel III. We all have heard about them, even if we don't all exactly know what's contained in the detail of them. You mentioned opportunities that presents. I'd like just to turn to Sam now and maybe ask him to talk a little about those opportunities from the perspective, not from an international group coming in and buying an African bank, but from what are typically known as challenger banks, truly local banks or regional banks. Perhaps you could let us have a few thoughts on that, but I think with a particular focus on what seems to me to be the case, that these regulatory restrictions cannot only be imposed upon international banks. I mean, these are across the board. So international banks will, of course, feel the pain and the pinch, but so too must local and regional banks. So perhaps you could talk a little about how you feel, what the impact of that is, and how you feel that has allowed you to operate, and how you've raised the requisite capital requirements.
Thank you, Rizwan. Good morning, everyone. My first comment would be to re-emphasize the pivotal role of financial services in the growth of overall services across the continent. Coming after John and your introductory remark, Rizwan, there is a obvious tremendous opportunity in the delivery of financial and especially banking services in Africa. The key growth drivers and engines of growth for the next mid and long-term horizon lies in the increased provision of SME banking offering, retail offering, pushing very innovative mobile and technology-driven delivery channels, taking advantage of a demographic dividend. I think John mentioned 40% of Tanzanian below 15 years of age, 50% of African population is below 19 years of age. So it's a common, element across a very diverse range of economies. And this young population is increasingly tech savvy, increasingly globally connected, and there is a tremendous opportunity for banks and overall financial institutions to take advantage of this. I think 2 or 3 years ago, it would have been very difficult to foresee that 2/3 of the African population would use smartphones. We're almost there, and this is a paradigm shift in the way to address financial inclusion related issues and increase the retail book of both local and international banks, because at the end of the day, both indigenous and subsidiaries of international groups operate in the same market. So taking into consideration these engines of growth, it's very easy to recognize that all these initiatives are fairly capital intensive. You have to expand network, both brick and mortar traditional delivery channels and also virtual. Requires a lot of investment in technology and human capital. And these, alongside amended prudential guidelines, reinforcing and increasing capital adequacy ratios, put a big question mark on the ability of African banks to raise new capital. So on the other side of the fence, you have 3 traditional sources of capital, and I'd like to comment on each of these, being first, strategic investors. These are both Pan-African and international banking conglomerate operators looking at building a footprint in Africa. We can reasonably say that for the last 5-10 years, there's been very strong dynamism, primarily driven by African groups. So very expensive expansion strategies driven out of West Africa and Nigeria primarily, or South Africa. Today, Standard Bank, South African group, generate 30% of its revenues out of the rest of African operations. This is 3 times more than 2010, 2011 situation. And you know, groups like UBA, Ecobank out of West Africa have built a Pan-African footprint over a reasonably short period of time. So I agree with John on the gradual withdrawal of traditional strategic investors out of Europe. But when looking at regional consideration driven out of Africa and increasingly out of Middle and Far East, I envisage that to remain very dynamic over the next 5-10 years. The second sources of capital is the global institutional investors. These are development finance institutions, private equity asset managers, hedge funds developing an emerging market, and private equity mandate. This is recording a dramatic growth in terms of new assets under management. I've been in Kenya 6 years, and pretty much for the first 5 years, the average number of new assets under management raised by these asset managers range from $1 to $1.5 billion every year. We're talking about 3 to 4 billion going forward. A lot of new liquidity to be deployed in African industries, corporates across sectors. And if you look at the priorities for these asset managers, the banking and overall financial sector has been amongst top 3, top 4, irrespective of the asset management, for a large majority of them at least. So there is an increasing liquidity, driving growth capital investment strategies, liability-driven initiatives, growing balance sheet of mid and even lower tier. And this is something very interesting on the back of impact investors you don't necessarily need to be a top-tier banking institution to attract global investors. Mid and lower-tier institutions have been able to unlock significant amount of liquidity. At least we've seen it in East Africa, and this will remain a very viable source of capital going forward to address capital requirements of African banks. And the last one, which is to me one of the most compelling at the moment, is the local sources of capital. And I'd like to take the Kenyan example, which is quite underpinning the growing liquidity and interest by local sources of capital. Alongside with the amended prudential guidelines around strengthening of core and total capital position, there's been a number of issuance of Tier 2 capital programs by Tier 1 and Tier 2 banking organization in Kenya. And if you just take the last 18 months amount of Tier 2 capital issued by 5-6 of the top banks in Kenya, we're talking about $280 million, 70 to 80% subscribed by local fund managers and therefore largest pension funds. So this is, again, a very scalable and very viable source of capital to address Tier 2, but also Tier 1 capital requirements. The fund managers in East Africa are becoming more and more interested towards private equity, pre-IPO investment opportunities, and definitely the banking sector will benefit from that. Is this still working?
Thank you, sir.
Yeah. Perhaps a final comment, Rizwan. Sure. We as a group, Chase Bank, which is a very diversified, probably one of the most diversified financial groups in East Africa, we've built a unique track record of growth. We're talking about 45% year-on-year growth for the last 8-10 years, last 4-year IRR of 36%. These are dollar-denominated performance indicators. Because of the diversification of our offering, touching on conventional banking services, Islamic banking, microfinance, bank assurance, leasing, and soon full-fledged insurance operations. The capital requirements that the industry is facing, we also have to address it, and we have structured a permanent capital vehicle called One RENA that will own significant interest and over time controlling interest in each of our operating entities, and also develop a buy and hold strategies to drive external growth initiatives in the region. The Chase Bank value proposition has always been anchored around financial inclusion, retail, and SMEs, and these are values that are, supporting a lot of issues in other Eastern African and ultimately Pan-African industries. And this is very similar to the permanent capital vehicle that Atlas Mara has built. We long-term investors, and I'd like to concur with John's comments around the tenor of capital. Sometimes private equity and traditional asset managers develop a 3 to 5 year investment horizon, which may not be entirely aligned with the timing requirements of banking institutions to embark on the long-term growth agenda.
Thank you, Sam. Just using the camera analogy that I used earlier, we've heard some good stuff. Thank you, Sam and John, in relation to the some of the pressures upon banks operating in Africa from a capital adequacy perspective. There may be a point I want to come back to if we've got time on that, but I think just to pick up on something you said there at the end, and it's one of the themes that I think I'd like to get across, and the panel will assist in this, and that is the whole concept of financial inclusion. So pulling the camera back a little bit, we've heard a little bit about the, as I say, the technical side, the financial side. But a bank in Africa cannot be successful in the long term, or the banking sector will not be successful in the long term unless it gives something back. So there's a developmental aspect, and perhaps I could turn to Sher Azam to talk a little bit about what he feels are the, are the ways and means of getting us to, to sustainable financial inclusion. Is this something that's a pipe dream? Can it be achieved? And how do we achieve it? Hopefully there'll be a role for technology to play and innovation to play in that. But over to you, Sher Azam.
Thank you, Rizwan. Good morning, everyone. I could spend the next 1 hour answering that question, but sanity prevails. I'll just talk about 3 points. In development role of banking, there are 3 points I would like to emphasize. One is the development of the capital markets to create long-term funding is one. 2 is giving greater access to credit. And 3rd is, of course, the favorite topic, which is financial inclusion. Let me talk about each one of these 3. Africa, the need for infrastructure in Africa is insatiable. One estimate, for the next 10 years, Africa would need about $100 billion a year in terms of financing to support its appetite for infrastructure. And today, only 50 billion is available. Now, it's nice to talk about raising foreign currency for local projects, but a lot of that has to come in local currency. For that to happen, capital markets have to develop. Kenya is one market where you have long-term yields, paper, but many African markets you don't. So there's a role to play in banks working with the regulator, working with customers like pension funds, people who have long-term money, to develop capital markets. This is not just for infrastructure, even long-term financing for mortgages. So apart from infrastructure, Africa is short on housing. And low-cost housing, middle-class housing, it's important to have long-term funding. So this is a key agenda that banks should be working through in the next few years to come. Second is access to credit. Today, if you look at private sector loans as a percentage of GDP, Africa is probably one of the lowest in the world. Of course, there are countries where it's as low as 15%. Even Kenya is 60%. We can talk about the opportunity of growth, but we should also talk about the obstacles to that growth. And the key obstacles are risk. Today, the cost of borrowing is exceedingly high in Africa. And the reason is the risk, adjusted yields. And these are caused by 2 things. One is lack of clear foreclosure laws. Sorry, the foreclosure laws even may be there, but the lack of execution against those foreclosure laws. So even if a loan is secured, it would take years to actually foreclose against it. And banks have to protect themselves, and thus places like Kenya, you have 3% ROAs to protect yourself from those kind of risks. The second thing is lack of infrastructure. Bureaus are developing in some of the markets, but not fast enough. Credit bureaus allow you to run businesses using data. Data allows you to discern between a good customer and a bad customer, allows bank to price for risk, and overall, you'll start to see the margins on loans start to come down as the credit bureaus expand. So these are 2 areas, I believe, which can give banks should work with the regulators again. My co-panelist will elaborate on that later. But those are 2 areas of access. Third point, very clearly, and that's the most popular topic, is financial inclusion. My own personal view is that the microfinance model has only worked partially. I don't believe lending at 60, 70% is actually a sustainable model. And why these rates are high are because the cost per account in both distribution administration of these microloans tends to be high, and microfinance institutions have to cover themselves. So what's the solution? Well, you have M-Pesa in Kenya. Today, it has 15 million customers. It has close to, I believe, 9,000 agents. And it has revenues of close over $300 million. And just to set context, the largest bank in Kenya has a revenue of about $400 million. So M-Pesa alone is 300. So they have evolved a very successful model, which broke even in EBITDA terms in 2 years. So that is a good beginning. But clearly, that's the direction microfinance institutions have to go. For that to happen, you do need clear credit bureau data, positive bureau that you can sort of rely on. But for that to happen again, bring in technology into Africa. You can be a pivotal, Africa can be a pivotal role in this particular area. There are lots of developments in the world today. US, you have models around ethnic segments, which are high risk for America. You can bring all these, test them out in Africa, but for that you'll need VCs and incubation. You don't need the pure traditional private equity models. For that to happen, again, there has to be an evolution process. So the 3 topics I was asked to cover, and I hope I've done them succinctly. Thank you, Rizwan.
You have, thank you. It's interesting you mentioned M-Pesa. Now, of course, that has been hugely significant, as you say, in its market, and it's being exported to the extent possible to other markets. But I'd like to turn to Tarun and just ask him in the next 2 or 3 minutes, perhaps to share with us some of the latest technological advances, because it seems to me that reaching out to the masses is the name of the game. And clearly one model is the M-Pesa model, but are there other things that can be done? Tarun, can you share those latest developments that you've been working on with us?
Thank you, Rizwan. Good morning, everybody. I come from a background of technology, and basically now in the last 2 years been merging banking with the mobile technology. Africa is a very peculiar continent, quite like India, but it's a little different. 10% or less is banked. Networks in the rural areas don't work on GPRS. Phones, what we take for granted are data phones, are these phones in Africa. 90% is this phone. Works on pure SMS. People know how to take a call by a green button. A red button is cancel a call. They don't know more than that. M-Pesa in Kenya has evolved the whole banking environment, taking care of the masses. The banking in Africa is different. It's not opening a bank account. The requirements are fund-to-fund, person-to-person transfer from a son to a father, son to a mother. In the village, I want to go pay a grocery shop. In Somalia, you can even pay for a cup of tea using a mobile bank, a mobile payment environment. The second requirement is bus tickets. The whole country lives on buses. There are no taxes in Africa. Third requirement is payment of your bills. Primarily is electricity and mobile phone top-up, which M-Pesa did very well in Kenya. It could do it because it was a telco. It owned the customer. But other parts of Africa, the telcos and the banks have been a little controlled by the government in saying, telcos do telecom, the banks do banking, payments, and wallets. So what we did was to build a platform merging the two. In terms of telco has a solution for the customers, the banks have a solution for the customers. We put them both on a single platform and take it to everybody. You know, Safaricom for M-Pesa has been a little bit of a volatile environment in Kenya. It's been, the banks don't like them, they don't like the banks. So we said, let's avoid that confrontation amongst other countries and build a common bridge where the banks are happy, the telcos are happy. And that's what we did in terms of building a secure, a small chip, which goes on to the existing SIM card of a phone. Telco independent, device independent, and even the operating system independent. The same chip works on a phone which is 20 USD. The same chip works on my phone, This works on data, this works on SMS or USSD. But the experience of putting everything together on one platform has worked very well. Telcos are happy, the banks are happy, and the providers are happy. Everyone says, we win, you win, let us go together to the market. Now coming to what we put on the platform was basic core requirements of customers. You go to Kenya and go on the road, a small vendor on the roadside will keep the phone over here. This is money. They don't say this is my phone, this is money. And you go into even say Somalia, this is money, it's kept in the phone pocket over here next to the heart. So we built essential services around that solution, but also now as we see the African economy expanding and the banking, digital banking going to the masses more and more, we brought in future-proof services for the people on the road. And on the road I would mean the roadside vendor, bus driver, the villager, the grocery shop owner, and the now common man in the urban and the rural areas. We see us as a credit card economy. Africa is almost zero on credit cards. Kenya probably has the highest number of POS terminals, maybe 2,000 machines in the whole of Kenya. You go to Somalia, zero. Ethiopia, the banks have them lying in the warehouse. They can't use them. So we said, how do we take the next step of credit cards and debit cards to the same solution? We put it together as virtual cards. So the backend now handles the self-assisted model for the customers. It also handles the retailer terminal where he wants to accept money from you. I can push money, he can pull money. I can go to him and say, pay my power bill, pay my school fees, take money, put that money into my wallet. I want to use the wallet for paying my bus ticket. I want to use that to pay my grocery shop. Put everything into one common platform. And the first country we've gone live, we're almost going live now, is Ethiopia. One telco, 35 million customers. Target is 70 million by 2018 or 19. But the banks and the telcos have worked very harmoniously together and said, let us now work for the customer, to take to him what he needs. And our self-interest is secondary. Also because the telco is a government-owned telco. And the banks are also old banks, traditional banks. They want something new to happen over there. Now, we've put it together, hopefully goes live by December, but the POCs have been done, the testing has been done by everybody. Both are happy. In India, we put the same thing together for the banks. One bank is live already. Small services are live, expanding. But the market for this is Africa. India is a different market. Africa is a huge, like a volcano waiting to erupt, as we see it. Somalia, Ethiopia. The next country we're looking at is Zambia. Mature market, but again, lacking in grassroots level financial inclusion services, banking services, payment services, and basic buy, sell, everyday use.
Thank you, Tarun. Extraordinarily fascinating. I'm sure there'll be more than one question from the audience. But in order to save time on that, let's move, I think, quite quickly to our last panelist. Now, it's all very well and good to have all the technology in the world and to have all the fancy concepts. But at the end of the day, all of that has to rest, to use the camera analogy again, to pull it all the way back, has to rest at the doorstep of an effective and efficient regulator. Mohammed, as the chairman of the Central Bank of Kenya, it would be, I think, most apposite for you to explain to us what you see as the role of a central bank regulator in helping get all of these things coalesced, in regulating so that there's systemic stability with, of course, inevitably there are one or two bank failures, such as, for example, the current topical one is Imperial Bank, and perhaps you can share some thoughts on that. But what really, Mohammed, are the lessons that can be learned from a central bank perspective?
Thank you, Rizwan. Obviously, as you can see, central bank has a very enormous task to perform. But what we need actually is an efficient and effective regulator. Let me share with you some statistics, actually. We have 38.4 million mobile phone subscribers. which is 85% penetration in the country. But we have, again, 27 million mobile money subscribers with 126,000 approved agents. Now, you can call these pseudo banks. Basically, you are looking at 27 million banks, if you wish, because everybody is carrying money and they can transact from their phone. Now, as central bank, we must be a proactive, efficient, and effective regulator, because all these mobile network companies have interfaced with the banks. Now, initially, there was resistance from the mobile companies of these, not the mobile companies, but from banks, of the services offered by the mobile operators, but they decided to join them. And therefore, that makes the work of a central banker fairly heavy. But apart from that, in the financial sector, we have many other regulators. Now, central bank plays a collaborative role between all these regulators. And that is why currently we are working on a concurrency regulations, so that we don't encourage operators to shop for the regulator that will give them the first node, and that is on course. But more importantly, you can have regulations in place, but as a regulator, you need to be a proactive regulator. You don't act when things have gone wrong. The intervention must be timely, and you know we are operating in a fairly dynamic global environment where regulation can be overtaken by innovation. And therefore, you must be on your feet. You must be ready to tackle the challenges that come with all this dynamic global environment. But apart from that, given that we are many players, we are many stakeholders, we hold the stick. We also are stakeholder, but we hold the stick. We are stakeholder at the same time. We need to put in place mechanisms to protect consumers, mechanisms also to educate, to give consumers financial education. And this, for me, is really key. You talked about putting in place infrastructure beyond brick and mortar. This is really critical to create that environment in which the various entities operate. Now, you can have these regulations in place, but implementation is always a challenge. Execution is always a challenge. And therefore, we must put in place best global corporate governance practices, because we operate in a global environment. We have entities that operate in Kenya that operate in other jurisdictions. And therefore, as a central bank, we play a very critical role to ensure that our oversight is effective and efficient. In case it's breach, we step in and remedy that breach, because the consequences are very grave. Rizwan, you mentioned bank failures. I can't say that we have had huge bank failures, but we have had some failures. But we must confront this problem, because it is a problem that can shock the system. Now, why is this a problem? And I look back to the 80s when we had really massive bank failures in the country. Why? Because of weak corporate governance systems in some of these institutions, where the policies, processes, and procedures are weak, or there's no enforcement, there's no sufficient oversight to manage the risks that are attendant with doing business. You have weak boards in some of these institutions. These are boards, let me say this, that don't ask the right questions, or may I say, don't ask questions. They're basically compliant boards. They sit there, And because some of these boards engage in groupthink, where they say, we are okay, we are not vulnerable, and nothing can happen to us. We have been in place for the last 5 years. Nothing has gone wrong. And therefore, you don't ask the right questions. You don't ask management the right questions. But more importantly, weak financial reporting. We have auditors out there. They are external. We have internal auditors. But also, the regulator has to bear a bit of blame, because if you are not proactive, you are not effective, you are not efficient, you are likely to be surprised by some of these challenges. I think this one I've answered that.
Thank you very much, Mohammed, for that very lucid explanation. I particularly like the idea of the stakeholder and the stakeholder. I'll remember that in my own dealings with the central bank in my country. Ladies and gentlemen, there's a very anxious man here who says, and the panel's time is up, and I think we'll probably have just a little time to take a couple of questions. I see there's a gentleman over there. Maybe 3 questions maximum.
Thank you. My question goes actually to the chairman of the Kenyan Central Bank. You've mentioned governance, good governance in financial institutions. But if my understanding is correct, the Central Bank of Kenya, as different from other central banks, has more than one board. In that circumstance, doesn't that in itself sort of dilute its ability to impose good governance? That's my question. Thank you.
Carlo, that's a very good question. Let me say this. In Kenya, and I think in England we have a similar model, we have a dual board. We have the Monetary Policy Committee, that is technical, and that is chaired by the governor. And then we have the main board, basically, which looks after governance. Now, there has to be separation. If you look at corporate governance best practices globally, there must be clear separation between management and the board. And the work of the main board is to look after the policy of the bank. And by mentioning policy, I'm looking at all other policies, except monetary policy, which is left to the technical wing. So our work is to put in place policies that will ensure that the bank functions properly. And let me say this. The Central Bank of Kenya is even in a better position because under the Central Bank of Kenya Act, the mandate of the main board is clearly spelled out. The mandate of the Monetary Policy Committee is clearly spelled out. So that we actually, apart from being regulated by the law, we are going to go to best governance practices. And as you know, if you have a good board design, by that I mean the structure, composition, and board processes, management will not struggle, and the institution will not struggle. That's how we operate.
Thank you. There's a question over there. And then the last one over there.
Thank you. My question is directed to my regulator, not on behalf of central banks across Africa. We've recently seen a significant increase in interest rates to protect domestic currencies. My question is, what do you think is the impact of this rapid and significant increase in interest rates on the stability of financial systems, noting that banks their funds are short-term, and when these rates go up, the cost of funding increases significantly. And banks have also recently lengthened maturities of lending, and the credit appraisals were done at much lower rates. When you pass on these rates to the market, what is the implication? Is it perhaps time to perhaps say we would rather have lower interest rates and let currencies go to where they need to be? Thank you.
Before you answer, Mohammed, I think just to say 1 minute for you, and then I'd like, so the central bank perspective, and I think the audience would, I'm sure, also like to hear a bank's perspective on that. What's the impact of that excellent question? Thank you. Mohammed first.
James, you have to be very careful not to ask your regulator too many questions because he may clamp down on you. but having said that, the question you ask actually, also technically, if I answer that question wearing the shoes of the governor, I'll be offending the law because monetary policy belongs to that other board. But let me answer this as a Kenyan. James, you know that the dollar has been bullish. It has affected many other currencies. In fact, the Kenyan shilling has survived much more than other currencies. I think in Zambia, and the Chief Justice is here, I know there were prayers the other day for the currency. I don't know how far that went. Maybe we should engage in similar prayers. But I know that the traditional role of central bank is to look at price stability and financial stability of the economy. Obviously, with the interest rates going up, there are significant effects on the economy. And I know that the MPC, that's the other board, is doing sufficient work to ensure that there is stability in the market. And I also know that the government has decided to borrow externally so that they can bring stability to the shilling and also bring down the interest rates. But again, I'll refer your question to the governor the next time you meet him to answer that.